Hi, everyone. Hope everyone had a good weekend. Alexander, Hugo, hello, Ryan.
Hey, Coach.
How are you, buddy?
Not too bad, mate. You? Nice long weekend?
Yeah, I want to wish all my trading warrior brothers and sisters that celebrate Yom Kippur a Happy New Year. Hope it's a great year for you, and not just the markets, but in your life. Shana Tova. Thank you, Michael. Happy New Year, Sinatra. All right, so what year is it? I don't know, 54 something, maybe. I'm guessing. You should know Forex, Gal. Anyway, it's a new moon. And, Friday's miss in the market on the NFP number was pretty dramatic. So I know gold had a great day and risk on was flying. But to me, the thing that really stood out to me, and I talked about it right after the release, was what the 10-year did. Okay. And the 10-year put in this candle. So as weak as the number was, I thought that was kind of a standout reaction to, weakness in the employment report. And here we are now back at the top of the range here in the 10-year. Yen's getting a pop on it. So, I mean, all the correlations with it. What else is the correlation with the higher yields? I think Tracy Schuchart says it's all about yields, right? So when you have yields rising, getting this pullback in gold, not great follow through from last week's action. I actually thought we might do a little better, maybe trade 1840, but maybe this was enough to shake out all the bears first. Perhaps we get one more pop up, but this could set up the break to buy at 1760. I'm going to be interested to see where silver. I have a better handle on where I want to buy gold than where I would want to buy silver. So I'll key off of gold once we're, I think we could be $50 lower here, 1760 or so. And if the end's going to go, it's got this, channel up here that could take it to 112. All right. So what else doesn't like high yields? I mean, it's not down hard, but the tech stocks don't. So we'll see what happens here. There is an old expression that I get confused every year. Is it sell on Rosh Hashanah, buy on Yom Kippur? Or is it buy on Rosh Hashanah and sell on Yom Kippur? So I think with what yields are doing, I'll go with the first one. And the Dixie, if you're a dollar bear, I really wouldn't want to see it trading much over 64. I still think that there's more left down to about 91, but it looks like we're going to get some type of pop here. Perhaps it's good for more than a day, but you have to respect how Euro's holding up compared to cable still. And we've been pounding the table on Euro pound for a couple of weeks now. Been talking about 87 being viable. Still looks viable to me. Okay. And, something else I want to point out that, I understand the bullish argument in oil, and, we had some damage done because of the hurricanes last week. But when you look at the daily compared to risk, use S&Ps, we have successive new highs in the S&Ps. And now we have, I guess you could even count this as 1, 2, 3 lower highs in the energy complex. So, something to consider. It's acting pretty weak. And so, economically, both the precious and economically sensitive Dr. Copper is down. So to me, it almost feels like if yields are starting to go up and we start closing over 136, it measures up to about 160. You could call it an ascending triangle, an ascending line, flat top. You just take it's just arithmetic. You take the 23 pips from the low and tack it onto a breakout, it gives you 160. So yields look higher to me, guys. You get a weak employment report, and yields, if they ever had a chance to break down, it was last week with that number. So I was neutral, but after the reaction to the NFP, that was a standout to me. And we know that yields can affect everything that we trade, every instrument. So to me, that was a key event on Friday. And Brian, what do you think? I know you follow the yields and yen. Does this look real to you?
Yeah, I mean, that was the standout thing on Friday. FX was moving, selling the dollar, and yields weren't. And yields weren't moving the same way, bar the spike lower. And the longer it went on, the more I was looking at it thinking, the dollar's going to turn back here. The market is going, this is a bad number, but some jumped on the wages being high as inflationary, but there's still skews in there between the different levels of pay that are in the market and not in the market. Low level pay jobs are not in the market at the moment because of the virus lockdowns, blah 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 blah. But yeah, it was the key thing. I mean, the trade I missed was dollar CAD. I've been speaking about that when the two big options at 125.50 and 125.00, and I was hovering around hitting 125 for a long, and I missed it, and then I did it again, and here we are now touching 126, and instead I'm in a euro short, euro dollar short from 1898, and it's 30 pips in the money.
Okay, so I look at Canada here. If we hold this level, I see a 1 here, Ryan. I see a 2 here. Maybe we're going to make a move to 31.
Yeah.
If the dollar turns up with a band. And, a few weeks ago when we were topping up here in the dollar, I thought that we could get down to 91. But, when you're working a narrative, it's a narrative. And you always say to yourself, well, where would the narrative shift, at least short term? And to me, the dollar back over 92.60. I really have a neckline kind of here at 92.40. This would be the first place that I would think it might have some problems. You had this horizontal old support turns into new resistance, and this looked to be a pretty significant pivot. So keep an eye on this level here at 44. It punches through there and you'll have something. I don't like to call an end to a dollar rally when the euro is still outperforming cable. That's the only thing that, tells me that I shouldn't get too aggressive on getting bullish the dollar, because the euro's not giving up the ghost like cable is.
No, and you're quite right. I think we may have a bit of divergence play there, with the ECB coming up. Market's going to be looking at the ECB Thursday to see are they going to be maybe a bit hawkish. But you're right. If euro dollar's not following the rest of them, then something's up, and you got to keep an eye on it. Yeah.
Okay. Well, Ryan, it's good to hear your commentary. Did you need a vacation from your vacation, or was it rest?
Yeah, I'll get one next year.
All right. So, anything else you want to report to us before I bring the rest of the crew in?
No, not much really. I mean, last week the dollar couldn't find a bid, as we know, all week, and then it's turned again. So, we're going to be watching these moves. We need to see the stock market today, see what the US guys think of the market after the NFP, how they want to set the stall out. But again, you can't trust anything you see. We could see cable dipping down to 137s. We could see euro dollar falling. We could see the dollar getting a decent bid this week, and then we start hitting some of the more solid levels, and it all turns around again. So don't get married to any of these moves, because we've seen it time and time again. You get married, and then it slaps you in the face.
And look at TLT, which is a proxy for the long end of the market. Just rallied back to this breakdown here a week ago, and rolling over. This was a much weaker rally than the short-term stuff. So this looks pretty negative to me. And, we higher yields, I think we're going to be talking about them this fall. So, we'll see what, this is going to be a big test for a lot of different asset classes to see how they even though, we still have negative, real yields are still negative. This is still, maybe all markets need negative yields to perform to the upside. If we break down in TLT, maybe the yields won't be as negative. Maybe they'll get to neutral, because I think we're only, what are we, minus 1% real yields.
Yeah, so, something like that. Yeah, I agree. So, but you look at looking at that chart there, just taking it from, sort of May, July, June, July. To me, that just smacks of consolidation, and it's the same in 10-year yields. We're having some moves, but if you look at the wider picture, we're hitting a little peak of consolidation where the market really doesn't know what to do.
Yeah,
and that's why we're flinging between highs and lows and the ranges, because until we get a proper direction, we're just going to stay in these ranges.
Okay. Well, we have a nice guest today. I haven't talked to Keith at IceCap Global for a while. We'll see what he sees melting up there in the Arctic and see what he has to say. Okay. Who's Dave, Richard? You have the wrong consonant. I'm Dale. Anyway, Dave's not here. You remember that movie?
Week.
Remember that movie? Cheech and Chong, Dave's not here? Okay, you guys are too young for me. All right, so Blake and Steve and Stell, how are you guys doing today?
Hey, good morning, Coach.
Hey, buddy.
Hey,
morning.
How you guys doing?
Everyone doing all right? COVID-free and everything? Everyone healthy?
I actually got some COVID tests for our family on Thursday of last week, so we could spend some time with our family this weekend. So it was good.
Okay. Good. What do? You go out and buy the tests at a pharmacy?
No, we go and get I believe they're called the PRC tests. They're just, they have to go to a lab and
you do a drive-through somewhere.
Right. We go through a drive-through and it's we're partnered up with some woman's health something or other here. So but it's nice.
My brother-in-law has it bad, and he wasn't vaccinated.
That seems to be like the theme. I don't want to really talk too much COVID topics, but it seems like people that are unvaccinated are the ones that, well, just because I have a friend of mine in the ER who's a COVID doctor. He's been, he's just been telling me what's happening last year. And then, he keeps me up to breast with everything. And he says, it's, mostly the unvaccinated people that get really sick. Anyway.
Yeah. All right.
Yeah, it tends to be the case. Speaking of which, it seems like, speaking of COVID, it seems like our numbers have probably peaked here in the US. They look like they might be starting to trend lower in certain hotspots, which is good, good for the US, probably good for a lot of other places too, that are keeping a track on what's happening in the US, since we tend to be, how should I say, less concerned with COVID here in the United States than other places. Yeah. So for that reason, that's probably good news. But, I actually wanted to ask Ryan and maybe Stelios and Steve too. We just had the RBA last night, and you saw the Aussie actually reverse course following the RBA. And this is something that I talked about on the week ahead video, that a break back below 74.20 was going to be bearish. And so now we have slumped back below 74.20. And what do you attribute that weakness in the Aussie towards from yesterday? What do you guys think there?
Well, I think the RBA were just pretty much as expected. They stirred the pot a little bit. They weren't dovish. They didn't adjust QE per se. They lengthened out the extension of it from November
right,
to
but it looks like they're going to continue with their their tapering plans. Yeah. So why did the Aussie weaken? Do you have any idea there?
Yeah, well, I expected it to be stronger, and I was looking at buying a dip into 74, and I missed it this morning. But I think this is purely just US dollar taking over at the moment. So we've got a bit of a line of the sand here at 73.90, in my opinion, because we've got that area 73.90, 74.15, 90. I'm going to be potentially looking at shorts just to see if I can run this dollar buy that we're seeing. But I'll wait to see if we get resistance coming in at 7,400 first.
Yeah, and I was gonna ask Stelios, is there anything that stood out yesterday in the RBA statement that you would have seen?
I mean, not really. What they're doing is they're being cautious, a bit like the RBNZ. So they're going to be eventually tightening, but it's like a wait and see. They talked about the Delta variant and how unemployment is going to increase probably in the short term. So they're being cautious, and I think that's the main reason why the Aussies is grinding a little bit lower. And again, we go back to the same thing that we've been talking about for ages, is that they always like to have an excuse to kind of delay tightening as much as they can. So, but in the grand scheme of things, I think the move that we're seeing is nothing. It's not nothing major. So it's I think it's a result of them being cautious, more cautious than the market expected. So I don't have much else to add.
How about bonds? We had a nice move in yields back up here in the States. Did the bonds get to your area where you wanted to short them?
No, unfortunately, I was looking for 178. They peaked at 177 in a bit. We're now below 175. It doesn't matter, you win some, you lose some. This one I didn't even trigger, but I still want to be short bonds. But and I thought that last week's payrolls number would have helped, but like you guys correctly said, it's not really responding. It's actually going the other way. So for me, the bottom line is that it was a bad number. The market is a little bit jittery. The market just, it doesn't know what to do with this yet. But I think that eventually the market's going to realize that the Fed, the chances are that the Fed might be a little bit more dovish than expected, and maybe tapering will be pushed back, or the pace is going to be lower than expected. I don't know, but it seems that central banks are getting all the excuses they need to not be as hawkish as they.
I dropped a picture of Paul in our Forex.
Oh yeah, I saw that. That was good. That was really.
That's
good.
when he's going to do it. Blake, you want to show that when Paul's going to? I know. Forget it.
Yeah, I'll pull it up in just a little bit, but but the thing I'm gonna go back to the Aussie because Michael said most of the Aussies still in lockdown. They expect lower economic activity. That is true. As I mentioned in the week ahead video, I talked to the guys in Pepperstone Securities, and man, they seriously are in some serious lockdowns. This is one of those times that I look around and you think in certain countries you go, wow, I'm losing my freedoms here, and I mean Australia has really been in he says it himself, draconian measures for the last couple of years. That people can't even go into into his home offices downtown. They've got the whole city walled off. Pretty crazy, right? Alan said, we got to pay attention to the iron ore prices, and actually, if you could pay attention to iron ore, or even better yet, in my opinion, if you take a look at
copper.
You take a look at copper, and where is my damn copper? It's up here somewhere. Okay, here's copper, and we got a nice little head and shoulder pattern playing out. You know what I mean? And so, copper probably is going to play back down towards this. I would say 410, 408, somewhere down here. And that's going to, obviously weigh on Aussie as well. Going to the dollar, and Ryan had mentioned the overall dollar strength. We were on the F.A.C.E webinar on Friday following the jobs report. I was looking for a short in the Aussie, or a short in the euro at 119. And I got short some euro dollars, and I stayed short. But I'm starting to see the euro pick up against other currencies. And so I'm not too sure if I really want to stay short, the euro dollar, because you can see the euro is actually starting to make a move against, well, you got the euro sterling that's breaking higher. You got the euro Aussie looks stronger. You got the euro New Zealand with a false breakdown below this. Oh man, where are all my drawings?
A great live trade, by the way, on Friday.
Oh, thank you on Friday. Thanks. Yeah, if you guys were here on Friday, hopefully some of you guys took advantage of that. But I mean, the euro is starting to look a little bit better against other currencies. Then we have the ECB this week. So let me ask you guys this: with the ECB, and I want to ask. I'll start with Stelios since he was just speaking. Regarding Lagarde, how do you feel about Christine Lagarde? Do you think she's going to have to start preparing the market for possible taper? I mean, I'm a little worried about that. I know everybody's got their own views about the ECB, but again, this is something that I explained during the week ahead video. The measures that central banks have taken during COVID were pretty extraordinary because we went into a serious lockdown. I'm going to reiterate, I don't think we in the US are ever going to go back into a lockdown state. I don't think the rest of the world is either. So are these bond purchases, the extraordinary measures that we're already at that we're taking? I mean, our central bank's going to start preparing to unwind that. So to you, Stelios, what do you think there?
Yeah, I think these measures are extraordinary and they should be reversed because COVID is being dealt with. I know it's not over, but it's being dealt with the vaccines and everything. So theoretically, they should be. Yes, they should already have started tapering and reverse all these. The problem that the ECB has is that that inflation hit 3% in the last reading, and the ECB is very sensitive to inflation. So I think Lagarde, there's a risk that she's going to start. Just like Powell, preparing the market for tapering. The problem, though, is that you have countries like Italy, which is huge, and everybody's today celebrating the fact that their deficit as a percentage of GDP is only 10% this year. So it's a tricky. The European Union was always a very tricky project because you have so many countries of different character and such a variety of countries put together in a single currency and a single union. But I think to answer your question, I think that chances are now rising that Lagarde is going to start preparing for some kind of tightening or basically tapering of these extraordinary measures. Yes, I mean inflation. It was a huge print for ECB for EU standards. That is. Yeah, I think we could be in for a surprise this meeting. I'm not saying it's the probable event, but they could follow Powell's lead and then do something similar, or at least tell us that they're thinking about doing something.
Right, thinking about.
Yeah, exactly.
What do you think there, Ryan?
Yeah, I'm pretty much in agreement. I think they're going to wait for the Fed to go first, and because we're still not decided on what's happening with taper. We know it's coming. We're just waiting for the details, more or less. She's going to be ever cautious, as she always is. See, it's a funny thing because people look at this as straight hawkish, dovish, but it's also whether it's bullish, bearish. That's what I look at, how bullish they are on the economy recovering. But yeah, I don't think she's going to lay anything massively that's going to send the euro flying. They've done it a bit different where we know what the emergency part is, and it's the PEP. So if that gets pulled and QE, the rest of the QE stays in place, it's not really hawkish because they're taking out the emergency stuff they should be taking out, and everyone knows that. And then we move on to, if you like, a proper taper and the dreaded talking about rates. But they've said they weren't going to let inflation run hot until the end of the year. That's when they expect it to happen, and then it's going to be diving early next year, according to their seaweed on the wall.
All right. Well, I'd like to get Steve's opinion. I would think Steve is here this morning, and I just want to say, Steve, if you are here, great job coming in. It was a holiday in the U.S. and Steve still came into the North American session, did the morning edge for all the ForexAnalytix subscribers. Guys, if you didn't know that ForexAnalytix, we do webinars throughout the course of the day. You're listening to the free webinar. Obviously, we do, we got the European crossover, the morning edge. We have, in our chat rooms, which were actually, there was people in our chat rooms yesterday, even though it was really slow. So Steve, well done yesterday. Do you have any opinions about the central banks and what the ECB is going to do this week?
Good morning.
Good morning, Steve.
Good morning, Dale. Good morning, everybody. And have a nice week for those of you that, were on holidays yesterday. So, my opinion about monetary policy and central banking obviously can't change overnight because it's not something that's adjusted, on a daily basis. I do think that all central banks are going to try to pretend like they want to do something. So I do believe they're going to go into a tapering cycle, but I believe it's going to be extremely underwhelming and slow, and it's never going to be completed before they have to step on the gas and increase quantitative easing in this case again. So of course I can't guess what Lagarde is going to say. I'm pretty sure that she will do, her best to remain as dovish as the situation permits. I also believe that the political situation in Germany, and that goes back to the commentary from Stelios, helps somewhat with the ECB in general being even more dovish than it was allowed to be in the past, because I think it's a matter of time.
Yeah, yes. Merkel's numbers are way down, like 20% on the polls.
Merkel has already run her cycle as a head of state, and things are shifting there as well. And as you've also seen globally, the shift for some reason is everywhere in the direction of more loose fiscal policy, which requires a looser monetary policy, because we've completely even stopped keeping the pretenses that central banks are not doing debt monetization. That's exactly what they're doing, and we can't even hide it anymore. So in order for you to have a looser fiscal policy, you just need the central bank to be buying your debt.
All right. Well, thanks, Steve, for your opinions about the ECB and about central banks. And, it's going to be interesting to see the next time we run into a big economic issue, post-COVID now, because central banks are just not going to be prepared. They're not going to have the ability to loosen. And you may end up being right. They may end up buying assets forever and ever and ever and ever and ever in a day. So that might.
I don't think it's going to be forever, Blake. At some point, I think the music is going to stop very abruptly, because there will be no alternative, and that's the day I'm afraid of, to be honest, because it's the political convenience, and I've explained before how political central bankers are, to, when you can't avoid the pain, to just postpone it for the future. But, whenever that future comes, and it will come, the pain is going to be unbearable, literally.
Yeah.
Just because we will have postponed the therapy for decades.
Right. Yep. Yeah, this is true. So, hey, really quick, I know, Dale, you're about ready to go into your interview with IceCap Global. I just want to mention, guys and gals, if you haven't visited our webinar sponsors, make sure you do so. We partner up with Pepperstone Securities, but Forest Park FX are the ones that make sure that we could do this webinar here for you daily. There are a couple different programs you can do with them. You can try to get ForexAnalytix for into our reimbursement program. But you can also, try to get cashback rebates too. It's something, if you haven't done so, make sure you do that. Chat with them right here on our website. You can go directly to them on Skype or send them an email. Brokers at ForexAnalytix is the one that they address and they answer. So make sure you visit them. They're the reasons why we can continue to broadcast this for you guys for free. So Dale, I want to say have a great interview. And for you guys, Steve, well done yesterday. Stelios, thanks for being here. Ryan, thanks for being here as always. And your thoughts, you two guys about Europe. And what a team. Thanks, Dale, for always being here for us every day. So I'll see you guys on the Morning Edge in about 45 minutes.
Call me unreliable. I'm not, though. But anyway, Keith, welcome back to F.A.C.E. Great to have you. I don't know how you got out of the rotation. I love your work. Waiting to hear you say hello.
Hey, Dale. Good morning, everyone. How's everyone doing?
Keith.
Good?
Yeah. It's been what's it been, about a year or so, Keith?
I think so. Has anything happened since we've been away?
Good one, buddy. You want to share your screen? We've had it's a green box.
Let's see. I was just going to do a video. I don't have a pitch book put together for you this morning. I thought we could just talk through some things.
Okay. All right. Do you want to use your video cam, or you have a pandemic haircut like me?
Here we go.
There you go.
Good.
Okay.
How's that? How do I look, everyone?
Yeah, I could run around to the different markets. Where do you want to start? It's been a long time since you and I have talked. So I'm curious, we were talking about that, it was over in the bond market, and really the bonds have been poor performers. I thought Friday's standout was the reaction in yields on a very weak number. Yields still ticked up. So to me, that was a standout. What's on your radar? What markets are you focused on right now going into the fall?
Yeah, well, at IceCap, so we're a global macro firm. So, 10 years ago, I launched IceCap, and, global macro wasn't that cool, so to speak. And it seems like, increasingly now, every year, quarter, a month, people are starting to, figure out that things are a bit odd out there in the investment world. So for us, Dale, we're constantly monitoring all markets. We'll go through a number of things that we find really interesting right now. But probably the number one item that everyone should be looking at now, it's really volatility markets. And I know most people think about the VIX when they think volatility, but you have VIX measurements, across all the commodities markets, for example, certainly the FX markets, fixed income markets, you name it. And most investors today, they've simply become too complacent. So when you look at any long-term volatility chart, you would say, holy smokes, so for example, if you're looking at FX volatilities, so say US dollar, euro, or CAD, Aussie dollar, yen, everything is now at record lows. If you look at it across, say, commodity markets, for say oil or gold, you're seeing the same thing. Credit spreads, I think everyone watches, equity markets all the time, but the fixed income world is where they really should be focused. We've been talking quite frequently now that, I like to say that, the global yield curve has been suppressed by central banks. So whether it's through, bringing short-term overnight rates down to zero or negative in some markets by using QE, for example, but credit spreads have followed them all the way down. And then, of course, over the last 18 months since the pandemic started, we have an enormous amount of capital just flowing into all markets. And it's just creating this moment where complacency has really placed most investors in this situation where they just have no idea what's about to happen. And when it happens, it's going to create some pretty dramatic moves in the marketplace. Well, like give an example. So for example, over the last 20 years, really, we've now had three market events in the equity world, we had basically, 40 to 50% drawdowns. So, going back to, a lot of people remember the 2000 market break and the tech bubble. And then, then we're looking at what happened in 08, 09. And then, of course, just back in March of 2020. And the reason that's important, institutional investors, they don't care too much about it. They live in a relative return world. They think, that's fine. They have an infinite time horizon. But most investors are not pension funds. They're not endowment funds and so forth. So if you take a big drawdown when you're getting closer to your retirement age, it takes a long time to claw back. So for example, for the 2000 and in 08, 09 corrections, it took investors, some of them, anywhere from 6 to 10 years to get back where they started. Of course, the March of 2020 correction, because there's so much money gushing in from our central banks, that recovery was a lot quicker. But we point this out because there is going to be another market event, and we do not think it'll come from the equity world. Equity markets will move as a result of it, but it will happen. And there's just so much complacency out there. A lot of investors, again, they're going to get pushed off sides.
Where's it going to come from? The corporate debt market, all debt markets, Keith? I mean, I looked at, I'm doing a F.A.C.E interview on F.A.C.E with you right now. So I have to show I really need a haircut. I'm going tomorrow. Anyway, listen, so everyone is, concentrated on everything's been going up, right? You're long the world. You have crypto, you have equities, you have certain commodity markets. They've cooled a little bit recently. What is and it's not going to start in equities. I have to guess it's interest rate related. Is that the surprise that the market's not prepared for? Not just a drift up in rates, but kind of maybe an out of control rise in rates. What's gonna pop the bubble in equities?
Yeah. So, for example, we expect the next market where we often refer to as risk will re-escalate. That's a calm way of saying, hey, it's going to get a bit funny out there. However, we view it as that happening in the emerging market world.
Okay.
So you could have a specific country event or specific region. It could be the bond market, for example. We've looked at Turkey quite a bit over the last 9 months. But once we see an event where it becomes risk off, and then here's the key, Dale, you get foreign capital leaving a market. And so think of the world, you have emerging markets, on the perimeter, and then the US is the core market, overnight treasury markets. Money, it flows into the core during bad times and back out during awesome times. The point is today, we are going to see this event. And because central banks in the Western world are, they're so strong, powerful, short-term rates are not rising, by the way. They are not going to go up based on a policy decision or event. Instead, it's the long end of the curve. That's where the real risk is. Okay. And as well, people following this closely, they'll say, hey, the Fed is not a QE. They're trying to hold down the long end. And that's true. The Europeans have a complete lockdown in the Eurozone region. However, they don't have a lockdown on credit spreads. They don't have a lockdown on long rates in the sovereign debt market. But as soon as we get one event anywhere offshore or the emerging market world, funny things can happen. So as an example, we're a Canadian firm, by the way. Yes. I think you have a lot of. I imagine we have listeners here from all over. I'm hoping some Canadians on as well.
But we're all loonies.
Yeah. So we have an election coming up here now in a few days. And, it should get a lot of attention, on the scheme of things. Isn't, the policy or the mandates for each party, they're really wearing a different color shirt in some ways. It's not a big difference or deviation. However, it is attracting a lot of attention. And then when you look specifically at the Canadian market, for example, it is a good way to view the world. Everyone in Canada right now, you realize, hey, we made a lot of money in our houses. House prices have gone straight up. And people say, oh, it's because, you always want to buy a house. There's not enough supply. Demand is so great. And foreigners really want to invest in Canada because we're such a great country to live in. So we have a bit of a different perspective on it. instead of thinking that, hey, foreigners, they really want to invest in Canada, instead you need to look at it and say, okay, why is Chinese money coming into Canada? Why is Middle East money coming into Canada, or Russian money, and so forth? Instead, you flip it around. You ask the question, why is that money leaving China? Why is it leaving the Middle East? Why is it leaving Russia? Because they're running away from concern, they're running away from risk, they're running away from that event thing that we just talked about. So then you want to go to an economy or a country that is perceived to have, a pretty stable political environment and economy and rules and stuff like that. But when you get foreign capital running into any market, naturally you get, all of a sudden, demand is greater than supply, and it pushes things up. So the real risk with Canada, and you can use this for example, for the Australian housing market as well, or any other one around the world.
US?
The moment, yeah, in the US as well, as soon as we get a spike up in long-term rates, okay, and it's sustainable, that's when it becomes a grind then, to fund your mortgage that's up for due for mortgage renewal. Canadian mortgage rules are different than the American market. All of a sudden, countries, governments, when they had to roll over the debt, they're no longer, borrowing at, say, 1%, 1.25%. Now it's at 2.5%. Or we look at what happened to Spain and Italy back in 12 and 14. It went from 4.8 to 12, overnight. But these are the type of events where people in equity markets, that they're not looking. They're looking at, hey, equities are great. Valuations don't matter anymore because money keeps flowing in. But we are likely going to have this external market event happening, and then that's going to push other markets off sides.
So is it, are you a proponent of the milkshake theory? That this is going to, if it's an emerging market problem, that ends up really giving jet fuel and the dollar a boost, which is deflationary, and we get a huge move to the upside in the dollar because it's become a safe haven instead of the most hated currency on the globe?
Yes, the potential for the dollar to surge higher is quite high. But think of it though as, it's not something that's linear. Nothing in the investment world is linear. It's going to go in big cycles and in secular movements. So in our mind, you're going to have, the emerging market FX world, something will pop there first. And then the next market that's in trouble will be like CAD, Aussie, Kiwi, Sterling, stuff like that. Then you have Euro and Yen. And then, by this time, everybody in the world, they want to hold dollars. Remember a few months ago, everyone was talking about crypto. So my mom, who's not an investment person at all.
She's in Dogecoin?
She was asking me about the dog coin and everything like that. Yeah. However, but think about the euphoria around that market, or the euphoria around, say, the tech bubble, and whatever one you want to look at. We think there's a very high probability that will happen with the dollar as well. So, for example, you're going to use, like, say, the DXY level. The DXY is about 93 this morning, I think, here. Yeah. Just DXY shooting up to 98, 99. It just, the world starts not to work very well. All of a sudden, you get a market event that goes to 105, 110. That's what you're looking at, and pretty soon you figure out, holy smokes, the world needs dollars to survive, and there's just not enough of them out there, despite all the, sort of the mainstream media stories.
Can you explain that to our viewers, Keith? Because people are seeing all the fiscal stimulus and everything the Fed's done, and it would seem like you would have a wheelbarrow full of dollars, and people would just, like in the Weimar Republic, just dump the currency and hold on to the intrinsic value of the wheelbarrow. So can you explain to people why there could be, or already is, a dollar shortage in the face of the Fed, and fiscally what we've done with rescue packages, et cetera?
Yeah. So first of all, what happened in Germany back in the early part of the century? They didn't get hyped.
Last century.
The last, well, I think we're there. And
look, they dragged me kicking and screaming into the 21st century. So yeah, I understand.
That's that's the vintage that I'm still living in. I was really cool in the 90s, by the way, and in the 80s as well. But with Germany, though, and a lot of people that they don't quite understand is that hyperinflation happened in that market, in that economy, not because they were printing money. They printed money because they weren't able to borrow anymore. So they weren't able to attract any more foreign capital coming to the market. So as a result, they had to print money. So there's a big difference with saying, hey, if you're printing money, you're going to have inflation. Because if that was the case, I mean, the Europeans would be up to their eyeballs in inflation right now. Because, they've been doing it more than anybody, since the 08-09 crisis. And they can't get any inflation in their system, based on the measurements that you're using. Same thing with the Japanese, or the same thing. As long as you're able to continue to borrow as a sovereign state or nation or government, you're going to be, you can continue to roll over your debt all the time until it doesn't matter. And that's the big point here. Going with the whole dollar story, for example, and demand versus supply. Let's just use the U.S. as an example right now. There's been a lot of QE in the American system, and the same thing up here in Canada and all that for matter. And people will mistakenly call that their money printing. Indirectly they are, but they're not really doing it. So a lot of people know this already, but if you don't know, this is what happens. The U.S. Treasury, they will issue Treasury bonds or bills. They're going to borrow money. The primary dealers buy it directly from them. So JP Morgan will buy it from the Treasury. JP Morgan then will immediately turn around and sell it to the Fed. But the Fed then, they do not give JP Morgan any money back. Instead, they'll credit JP Morgan's reserve account at the Fed. So the only way for JP Morgan to stimulate the US economy, because of the QE that took place, is that JP Morgan then has to lend on the reserves that are in the bank, that held at the Fed. So JP Morgan, Bank of America, you go through all these guys. And what's really interesting, if you look at loan growth in the US economy ever since the pandemic started, it continues to grow slower and slower and slower. At the same time, when QE is going up this way, same thing in the Canadian market, the European market, the Japanese market. So the point is that you can do all the QE in the world. You're not creating this hyperinflationary market. Now, at the same time, I'm sure there's some chuckles right now saying, hey, there's a lot of inflation out there right now in the system. So let's just talk about inflation real quick. How much time do we have, Dale?
We have some time. We have about 10 minutes or so, Keith. And so then is most of the inflation supply chain issues that will be resolved?
Yes, and mostly yes. So for example, back in Q1, you had the 10-year in the US go from around 70, 75 basis points up to 175 almost. And whenever you get any market move very rapidly, in a near vertical line, up or down, market estimates and expectations, they always overshoot. So back in Q1, all of a sudden I'm reading, the 10-year is going to go to 3. And then the next guy says, no, it's going to go to 4. Or another guy says, you know what, this is just going to cause the US government to just crumble overnight. Like they're losing control. As soon as you get that kind of a rhetoric taking place, and then if you look underneath the way the system was put together, then you can say, hey, wow, this is a great opportunity. So for example, shorting the long end of the curve back in Q1, that's where you made money this year. It's not being long equities, it's getting this call right. So back to the whole inflation story. A huge component of the inflation story is driven by the supply shutdowns. And we had the view back then, we wrote about it. I wrote a piece called Californication back in May, called IceCap Global Outlook. And we addressed this specifically, say, hey, once the global shutdowns or supply chains come back online, you're going to start to see, some relief in the inflation data. And that's the way it's starting to turn, and the market turned that way as well in the bond world. However, our concern again right now is that, we'll start to see more shutdowns take place. One of the largest ports in China, they're now shutting down again. They're experiencing supply disruptions. And as soon as you get supply disruptions in any market, again, you go back to the supply versus demand, supply equals demand or minus demand. That's what really drives all markets, in a bit of a, going to an extreme level. So at this point in time, if we continue to see more lockdowns coming up, which I suspect we'll see up here in Canada coming out in the fall, it will happen up here. And, you can start to see some more inflation numbers coming through. But there's been a lot of policy errors taking place over the last 18 months. and it's irrelevant what we or you believe that policymakers should do. Instead, you have to look at it and say, what are they going to do? And it's very clear central banks, they're going to continue to keep rates low. You know, there's talk of them becoming a bit hawkish and with tapering right now. I suspect that talk will end in a couple of months. And, you know, they're going to say dovish all the time. And governments right now, as long as they're able to continue to borrow at low rates, they're going to run huge deficits. So investors have to prepare that it's a lot of stimulus will continue to come online, and then something's going to get tripped up here in the marketplace.
Okay, so all this talk about starting a taper never even begins. Do we do a taper here? Does Lagarde start a taper? And you know, they're having a meeting this week, the ECB. Are either of these central banks going to taper, which isn't exactly tightening? It's just not as much liquidity.
Yeah, that's a good way. But everything, you know, it's really, you know, it's the rate of change, right? So if we get a slower rate of change, then it, you know, it is sort of less liquidity coming in. For the Europeans, the ECB has ruined their bond market. Their bond market and currency market and banking system has been completely ruined. They may try to talk about taper, but it is highly unlikely they will ever get to the moment in time where they're going to be able to taper. For the Americans right now, you know, they're talking about it. They're going to try to do it. But just think of what happened. I think it was in 18 when Powell first started raising rates. You know, 1/4 point at a time.
Oh yeah, before he got called on the carpet by Yellen and Bernanke, and they sang "Kumbaya." And
yeah, but what happened? The key thing though, when the Fed did multiple 1/4 point hikes, I'm getting my year wrong. I think it was 18. I think they were doing it.
His first year of his term, he was a hawk.
But it started just sucking money. This is part of the milkshake theory that you were referring to earlier. It just starts sucking capital out of every other market in the world. Because all of a sudden you can invest in the most, so people don't understand as well about the treasury market and T-bills especially. It is the only market in the world where you and I can take billions of dollars, throw it in the morning, and then take it out again in the afternoon and not affect the price.
Yeah.
So that's what the definition of liquidity is. You can do a transaction in and out and not affect the price. You can't do that in the housing market. You can't do that mostly in the stock market. Forget about corporate credit markets, FX world, you know, move outside of USD and stuff. It's really tough. Housing market, if anyone's using the housing market as a way to store the wealth, they think they have liquidity, no way. Because the moment in time you want to sell, you know, there's no buyer, and you get this huge gap down. So I think what will happen with the Fed and QE, that I mean, they're talking about it, they want to do it, but if they are able to start to do it, it's just going to further perpetuate dollar strength, which just sucks the life out of every other market, especially emerging markets. But the bigger thing that's happening as well, Dale, you know, in Washington right now, they're trying to push through this large budget.
Yeah.
There's a lot of reasons
infrastructure, why. The first do you think they'll get any of it done, you know, in this political environment? Do you think?
No. So right now, if you're for politically, I mean, we have some pretty big elections coming up in the U.S. next year.
Yeah.
You don't want to be the guy that said, "Yeah, I voted for this enormous amount of stimulus," because I'm running against you. I'm using that against you, and I'm going to beat you on the head with it all the time. So what's happening right now in the U.S. political world? You're looking around, and the economy's doing okay. Stock market is up. Everyone's making money. Like, hey, these are fun days. I suspect you're going to need to see a correction in equity markets, like some kind of an unkind economic or financial market event. Then that will give politicians then a reason. Yeah, they'll say, hey, we need to do this again.
Yeah, so that's another reason why. Their constituents will call them and complain because their portfolios are down 20, 30%. And also, Keith, before you go, I actually have a news flash to share with you, and it just came across, and I now know when Powell is going to tighten. There he is. See that?
So it's not next year then. It's not
Jay
next
Powell
year.
announcing the first rate hike. And you know, they say it really, you know, the job of being the president ages people. Look at what's happened to Powell in his term.
It's
anyway, I had to do that. Okay.
that's good.
You know,
but, you know, just to leave everyone with, though, spend some time on volatility markets. And I don't mean the VIX. You know, the world is now perfectly set up to get a pretty strong reaction to an increase in stress. And we're not bearish. So, for example, you know, we can tell a pretty good story about what's wrong with the world and what's dangerous in the world, but don't misinterpret that as ice capping and bearish on equities. So we're at what we call like a neutral kind of weighting in our equity world, but equities will certainly come off if we get an event coming up. But you have to understand that the risk in the world today, it's not the equity market. There's always residual value in the equity world. As soon as the bond market experiences stress, then you get permanent capital loss. And permanent is permanent. It's gone. It's wiped out.
All right, I got to ask you. Then I have to bring up. I have to share my screen one more time, and you know, you're an expert. Explain this to me, okay? I want to show you two charts, okay? I want to show you. Where is it? This. Okay, I want to show you. Let me get this out of the way, and you tell me, because I've been asking a lot of people, and it's about junk. And it's about investment grade. So here's the HYG, the junk, right? Pressing the highs. And here's investment grade corporates. They look like they're rolling over. Why is money flowing more into junk, which is a lower grade, higher risk instrument, than into investment grade corporates? Is it just because they get a better yield? Is that their reason?
Yeah. So for the uninformed,
like dumb money wants a higher yield, and they don't know the higher the yield, the higher the risk.
So we, you know, I had this conversation with the Bank of Canada there a couple of years ago, and I said, hey, are you guys comfortable with socializing the bad debt problem? To which they didn't really appreciate the question. So,
okay.
However, but this is a perfect example of it, Dale. So think about the most conservative investor in the world. A few years ago, you were buying term deposits for GICs here in Canada. You were making 4 to 7% on it, and you were able to have your very comfortable lifestyle. Now, all of a sudden, with those same investment options, you're down to basically 0%. That's where you are. So then your bank says, well, let me introduce you to the investment advisor. And they say, hey, yeah, we can get you 4, 5, 6%. That's right. Easy to do.
Yeah.
And they say, is it safe? And of course, the response is always, yeah, of course it's safe. Everything is always safe.
Everything's safe. Yeah.
So all of a sudden, though, you have the most conservative investors in the world. Now they have all their money tied up into high yield or junk bonds. Preferred shares are hugely popular up here in Canada, where they're buying dividend paying, equities with high yields on them. So all of a sudden you have the most conservative investor in the world. It doesn't matter if they're Australian, American, German, Italian, you name it. All of a sudden they have this full on with a risk on investment portfolio. And then you get that market event happening. It's pretty tough. So like, for example, March of 2020, there were a lot of really tough conversations out there where investment managers had with private clients, and some people were down 30 to 40% in a matter of days.
Yeah.
And granted, the recovery did take place. However, that's only with hindsight. So at the time, you had what's lost in the industry, and it's a real shame. Investors are people too. We really are, and there's very little sympathy or empathy for the private investor these days. And so we had the pandemic striking back then. People were concerned about everything from healthcare perspective, really social scare. And then all of a sudden they look at their retirement portfolio and it's just whacked in half. And they're saying, I thought I was in the safest investment ever. So, now we're back to that moment again. Another thing to look at, I would look at credit spreads, HYG, J&K, I would look at as well, but look at credit spreads. And what was interesting, when equities were down a few percent there a couple of weeks ago, and then they started to recover, but credit spreads didn't recover. Credit spreads, were staying wide at the same level. So there's lots of clues out there. You don't need to be absolutely terrified of equities. However, be prepared for a down step coming up.
Why not buy some insurance? I mean, we buy insurance for our homes, fire insurance, not because we hope there's a fire.
Yeah, that's a great point. I mean, you hope you never have to collect on it.
Yeah.
But, there's lots of...
People say it's a waste of money now, Keith, to hedge your portfolios. Well, it's affecting my performance.
That's true. But what we're finding, though, so we have new investors coming to us all the time. And all the investors coming to IceCap, they're engaged. They know things are a bit funky out there, or they really know things are funky. And then if you show how you're able to structure your portfolio and your investments so that, ultimately what you want. So I managed money offshore for a long time for some wealthy people around the world. They just saw the world differently. None of these investors were all invested in the equity market. All they wanted was consistent returns like this. They didn't want that. They don't want that 2000 drop. They don't want the 08, 09 drop. They definitely don't want the March of 2020 drop. They just want this going.
Yeah.
And, there are still ways to achieve that because, the way mathematics work, if you lose 50%, you get 100% return to get back to where you started.
Right.
But boy, there's a lot of euphoria out there these days. You go for a pint with your friend or a coffee or a walk and everyone's talking about, they tripled their money last week.
Sure.
That means that it's
getting closer.
Yeah, can be a bit concerned.
Okay, Keith. Well, thank you so much for your time and your giving spirit to come and share your views with us here and edify the F.A.C.E community. I appreciate it. And let's not let as much time pass between our conversations. And you could follow Keith. Is the best place to follow you on Twitter at IceCap Global. Is that
correct?
The best?
That's fine. Yeah.
Is that, and your website's the same, www.icecapglobal.com?
No, it is IceCap Asset Management.
Okay. All right. Well, thank you. Good hunting to you, Keith. Great seeing you and having this conversation, and hope that all your decisions turn green for you and everyone else that you work with.
That's great. Thank you, Dale. Take care, everyone.
All right, Keith. All right. Thank you, buddy. All right, everyone. So you could join the team. You're welcome. People, here's a comment from Anthony. Great interview, insightful perspective. Thank you both. People enjoyed this interview, Keith. So thank you very much. You could join the team in 13 minutes for the Morning Edge. And Happy New Year again to everybody that celebrates Rosh Hashanah. And we'll see if sell on Rosh Hashanah, buy on Yom Kippur works. And we'll see everyone tomorrow. Adios. See you, Laura. You're very welcome, everyone. Thanks again, Keith Dicker. Adios.